I recently came across an article that grabbed my attention. Here are the 8 ways the richest Americans avoid paying taxes. And a lot of times we hear or read these types of titles and think, well, that doesn't apply to us. But today I want to share these 8 ways with you and how you can help apply them, the same strategies that multimillionaires and multi-billionaires use, how you can apply them to your situation to help reduce your long-term taxes.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. And today, my goal is to potentially help you reduce your taxes. So, surfing the web actually is on my phone and going through a bunch of articles, and one that caught my attention, and I wanted to click on it. I wanted to click on it because I didn't know if it was what they call clickbait, right? Kind of that false advertising scheme, and then the article, there's really no good information in there, but if there was good information in there, I wanted to be able to share it. And the article was titled, "Here are 8 ways the richest Americans avoid paying taxes." It was on The Ascent. So you can see how it caught my attention as we talk on the show all the time about potential ways to reduce your taxes. Another reason it caught my attention is because sometimes people think, well, the reason that person gets the tax breaks is because they're rich. And so I wanted to read through these, and I'm going to start kind of actually just sharing with you the beginning of the article. And we're going to go through the 8 ways today. Some of them we're going to spend some more time on. Some of them we're going to blow right through. But I wanted to talk through these because here's how the article started. I thought this was good. It says, "Have you ever heard that multi-billionaire Warren Buffett pays a lower federal income tax rate than his secretary? It's true. And he isn't alone. Many ultra-wealthy American households pay surprisingly low effective federal income tax rates, and in some cases, no taxes at all." Right away, right? What are we thinking? And you might not even need to read this article. You may have thought this before. I wish I could get the tax breaks like the big guys. Sometimes we get a little frustrated. Oh, the rich don't pay any taxes. Well, or how is this fair? Right? Sometimes we go to that. How is this fair? Well, the rich, the wealthy, and actually normal everyday people just use a lot of fair legal ways that are tax breaks to them. Legal ways to reduce their taxes. Legal ways to help reduce what they owe to the IRS. These ways are actually available to you. The thing is, though, is that you just have to know the tax code or work with someone that knows it. A lot of these that we'll go through today, and I'll tell you which ones, but a lot of different ones here are actually things that we're using with our clients. And you might be utilizing them yourself, some of these strategies, and not even know it. So the same laws are available to all of us. It's the tax code. It's what it is. And it's just knowing and understanding the tax code. So today, I wanted to go through what he's got written in this article here, the 8 ways the richest Americans avoid paying taxes, help you understand those ways, because sometimes when we hear big names like Warren Buffett or Elon Musk or Jeff Bezos, we just kind of, our minds shut off, like that's not available to us. We can't do that. How are we able to get those tax breaks? They have a lot more money than us. And instead, we're going to take this down to what these strategies mean to us and how we can utilize them in our situations. Okay, so let's start off here. Number 1, no taxes on unrealized capital gains. And I'll just kind of read a little bit here from the article. I will link to this article on our show notes. Again, you can go to lifemoneyshow.com. Click on the show notes, lifemoneyshow.com. Click on the show notes. We'll have a link to the Ascent article here. It says the number 1 reason most billionaires pay a surprisingly low amount of taxes is because many don't have much income at all. Instead, their wealth is tied up in stock and other assets, I'm going to include here, like their business. Under U.S. tax law, you don't pay any tax on investment gains until you sell, no matter how much they've gone up. This is an unrealized capital gain and can be a great tool to defer taxes on your winning investments. I know what you're thinking here. Well, not like Jeff Bezos. I don't own Amazon to have just this one really big unrealized capital gain. However, and this is another one where I think sometimes people see these things on the news and they feel like, well, Jeff Bezos or Elon Musk, and I'm guessing, yes, they pay taxes, right? But then we see that their net worth has skyrocketed up and we think, oh, they're cheating the system. But you know what? You actually are using the same system that they are. Let me just give you an example let me just give you a short example here. Let's just talk about your home for a second. After you've purchased your home. Now, if you purchased it the top of the market in 2008, this might not hold true to you, but let's just think about your home. You purchased your home. Has it gone up in value? And are you still have you purchased your home? You're still living there, right? Has it gone up in value? Do you feel that if you don't sell your home, that you should still be taxed each and every year that it goes up in value? So, for example, you bought your home for $500,000. Let's just say you bought it at the beginning of 2023. By the end of 2023, you go to some website. It says, you know what? Your house is now worth $525,000. Do you feel you haven't sold yet? You're still living there. Do you feel like you should pay tax on that $25,000 of value that your home went up? I'm going to guess most people would say no. And see, we've brought this now to an understanding of we're utilizing the same system that these multi-billionaires are utilizing in their businesses. Instead of a home, it's a business. It appreciates in value. As long as they're not selling their ownership or selling shares of their stock in that business, well, then they're not going to pay the tax on that business as it goes up in value. You could probably think this is maybe still fair, still not fair, but I just wanted to relate it to something that you might think about, like your home. So this is what the wealthy are doing, but they're doing it with businesses, and they're doing it by holding stock in different businesses. They hold it, the value goes up. As long as they're holding it and not selling it, well, then they don't have any tax. However, just so you know, when they do sell, when they do want income from their business and they need to sell stock to create that income, yeah, they're going to pay tax when they do sell some of their shares. Now, you might be thinking, wait a second, I don't have the money to own a business, to start a company, to be able to do what they're doing. But if you have money invested, now let's go into non-retirement accounts. If you have non-retirement money invested and you buy a stock, for instance, maybe you buy a share of Amazon, since I've been using them as our example here, well, you're doing the same thing. You own a portion of Amazon. As long as you hold that share of stock and it goes up in value and you don't sell, that's unrealized capital gains. The value, your value, continues to go up until you sell. Once you sell, that's when the taxes come in. So how can you take advantage of this? One, you might already be with real estate, but the other is if you have a brokerage account, most likely that you're taking advantage of it. Or if you don't and you want to take advantage of no taxes on unrealized capital gains, what that is, it's starting a brokerage account, a non-retirement account in which you take ownership of stocks or funds. Same thing goes for a fund. It doesn't always have to be stocks. You can buy an ETF. As long as you don't sell it, you hold it, it goes up, you have no tax on the gain. But just like them, if you need income from it, you decide to sell it or a portion of it or a portion of your shares, well then at that point in time, you're going to have tax on those gains. We'll talk about those taxes in a second here. Okay, number 2 on this list, the list of here are the 8 ways the richest Americans avoid paying taxes. Well, number 2 on the list is charitable deductions. And I'm going to talk a little bit from the article, then kind of give you my thoughts here. It says, how does Buffett pay a lower tax rate than his secretary? The answer is he donates billions of dollars worth of Berkshire Hathaway stock to charity each and every year. And as he's entitled to do, claims some of these donations on his taxes. This effectively cuts his taxable income in half. While you and I are unlikely to have a charitable deduction equal to half of our income in any given year, taxpayers who itemize can certainly get a nice tax break for their generosity. So can you do this too? Well, yes, you actually can. Of course you can. You can give to charities. Now, the thing here, I'm not saying that you have to give half your income like Warren Buffett here to charities, but the thing here and the key word here, because I don't want you to just go and donate and think that you're going to get this massive deduction on your taxes. The key word in this number 2 is itemize. And here is why this is a tough one for maybe for some folks, right? Actually, some folks, they are able to do this. Some folks might not be able to. So I want you to be really careful with this. If you think, oh, I'm going to go and start doing all these donations because I want to try to reduce my taxes, again, something to pay attention to, the word itemize. You see, the Tax Cuts and Jobs Act increased the standard deduction back in 2017 when it passed, meaning if you're married filing jointly, you get a standard deduction on your taxes this year, 2023, of $27,700. If you're single, that standard deduction is $13,850. What does that mean? Well, all of your deductions, let's say you're giving to charity, you might have mortgage interest, maybe you've got taxes that you're able to deduct. All of those deductions need to surpass your standard deduction for you to be able to get the benefit, the tax benefit, right? There's always an emotional benefit, there's a charitable benefit, but the tax benefit, you have to surpass that standard deduction to be able to get the tax benefit of giving to the charity. So that's where it can help some, might not help some, but that's where this one comes in. So is it a way that only the rich can use? Absolutely not. Other people can use this tax reduction strategy as well. Now, here are some actual additional ways to get tax deduction from giving to charity. So you might not be able to surpass your standard deduction this year, but some other ways to actually help benefit your taxes and give to charity. If you're age 70 and a half and older, one of the strategies that we utilize with our clients is called the qualified charitable distribution, where you give directly from your IRA to the charity. If you do that in the right manner, then you do not have to claim that money that you've taken out of your IRA, because IRA money, you always have to pay income tax on it. If you give directly, you don't have to pay income tax on that money given from your IRA. The other one is that maybe you want to start what's called a donor advised fund. So maybe you're giving $10,000 a year to charities. As you can already see, $10,000 a year if you're married filing jointly, it's not surpassing that standard deduction. But if you bunch multiple years together, maybe you've got some funds sitting in your brokerage account or in your savings account or wherever, and you know that you're going to give that money to charity. Well, if you bunch multiple years together, put it in a donor advised fund, you can give it over your lifetime, not 1 year, but you give it over your lifetime. Well, now you can, let's say you put 5 years together, that's $50,000, surpasses the standard deduction, you're going to get that $50,000 deduction on your taxes. Blowing right through that one, but donor advised funds, if you're somebody that's charitable, that might be something that you want to look into. All right, let's move on to number 3 in the article here. Number 3 is long-term capital gains rates. The article says billionaires generate a disproportionate amount of their income from investment income, both in the form of capital gains from investments they sell and dividend income they receive from their stocks. Profits from investments held for more than a year, as well as most dividend income, gets taxed at a significantly lower rate than ordinary income. This is another one. Everyone benefits from this in their non-retirement accounts. Here's the key, though, if managed properly. So if you have a non-retirement account, meaning a brokerage account, a joint account, an individual account, a trust account that you have investments in, you benefit from this too. Again, though, if it's managed properly. What do I mean by managed properly? Well, long-term capital gains rates are more favorable than your ordinary income tax rate. Long-term capital gains rates could be 0%, 15%, or 20%. What do I mean by managed properly? Well, long-term capital gains rates only come into play if you've held the asset for 1 year or more before you sell it. So under 1 year, you're going to pay short-term capital gains rates. That's your ordinary income tax rate. Over 1 year, those long-term capital gains rates. Okay, so let me just give you an example of what I mean. If you're Married filing jointly, let's say you have $200,000 of income coming in, that would put you in the 24% tax bracket. Let's just say you need more income. You're going to need more income. You're going to your brokerage account to get it. Well, if you're taking a stock, something that you've owned, and you're selling it, but you didn't own it for 1 year, guess what? That short-term gains, that's going to be taxed at your ordinary income tax rate. In this example that we're talking about, that's 24%. Let's say you've got interest in a savings account or one of those high-yield savings account. Interest is taxed at short-term capital gains rates. Interest is taxed at your ordinary income tax rate, again, 24%. Let's say you're taking more income from your IRA. IRAs are taxed at your ordinary income tax rate, 24%. But again, if we're managing your income and your taxes properly, let's say you have a brokerage account. And in that brokerage account, you have a stock. You held it for more than 1 year. Then you sell that stock. Well, based on our example here of $200,000 of income, now when you're using this asset that's in your non-retirement account, held it for more than 1 year, that's long-term capital gains rates, more favorable. So instead of that 24% that you would have paid on that other income, you're going to pay 15% because it's that long-term capital gains rates. Qualified dividends. So dividends that you get from your brokerage account, again, something you want to look at because ordinary dividends taxed at ordinary income tax rates. Qualified dividends, long-term capital gains rates. This example here would be 15% instead of 24%. So this is where the small things can really add up. I see sometimes people will just have way too much sitting in their checking and savings accounts, and they feel really good because they put it in this high yield interest-bearing savings account where they're making great interest. But what they don't realize is that interest that they're making, that interest, they're going to get taxed at their ordinary income tax rate. And they don't even plan to use that money for years and years. Now, if they would just take that money and they would invest it, or whatever they feel comfortable in that savings account money, and they'd invest it, they'd hold on to a security in their investments for more than 1 year. Well, now the gains on that money, they're going to pay long-term capital gains rates versus that ordinary income rate. The other thing, just looking at the investments that are in your brokerage account, have you ever looked at how many are producing qualified dividends versus ordinary dividends? That's ordinary income tax versus long-term capital gains rates. These are things that we're looking at, strategies that we're utilizing with clients to help them in reducing their long-term taxes that they pay to the IRS. All right, following the article here, 8 ways the richest Americans avoid paying taxes. Number 4, you're going to say, wait a second, I'm already using that one. You're right, and I'm telling you what, it's what they say here in this article that the rich are using too, and that's IRAs. Particularly here, Roth IRAs. Now, I'll let you go ahead and read the article on this one, but it's a little bit misleading because as we all know, when it comes to Roth IRAs, and as we've talked on the show, you have to pay tax on the money that you put into the Roth IRA. There's no putting money into the Roth IRA tax-free. So you got to pay tax on the money that you've put into the Roth IRA. However, once it's in there, it grows tax-free, and you can take withdrawals tax-free as well. The example that they use is how one particular billionaire took the shares from his company's stock and put those into his Roth IRA. Well, his company took off, right? Like any potential stock could take off that's in your Roth IRA. Well, his company really took off and made him a billionaire in his Roth IRA. Of course, growing tax-free, withdrawals tax-free as well. So this one I'm going to say maybe the article's a little bit misleading because you do have to pay tax to get your money into the Roth. But yes, it's going to grow tax-free and your withdrawals will be tax-free as well. I'm assuming if you're still with me on this podcast, one of your goals is to help reduce your long-term taxes. This is part of our annual strategy with all of our clients. We have a year-end tax strategy and tax planning meeting. But one of the things that you might be interested in is our free guide to unlocking hidden tax savings opportunities. You can get this at lifemoneyshow.com/taxes. lifemoneyshow.com/taxes. It's a guide of strategies to help you reduce your taxes. It's going to give you actionable advice, a checklist to utilize, but most important, what this guide could mean to you is helping to reduce the taxes that you'll pay to the IRS, meaning keeping more of your hard-earned income, your hard-earned retirement savings with you versus giving it to the IRS. So lifemoneyshow.com/taxes. All right, what's next on our 8-point checklist here? The 8 ways the richest Americans avoid paying taxes. Well, number 5 is pass-through income. I'm just going to read this one. We'll keep it short on this one. If you're about to retire, which if you are, you might be, if you're listening to this show, most likely you might be about ready to retire or thinking about retirement. This one may or may not apply to you. So pass-through income. As part of the Tax Cuts and Jobs Act, which went into effect in 2018, pass-through income, such as from an LLC or partnership, gets a 20% tax deductions. Many wealthy individuals are business owners, so they benefit from this, but it also applies to pass-through income from small businesses and self-employment income as well. Now, if you are self-employed, I'm guessing that you and your tax preparer are taking advantage of this. If not, you want to talk to your tax preparer to make sure that you're taking advantage of this. If you're about to retire, you might not be able to take advantage of this one, right? If you're not thinking, wait a second, I'm about to retire. I'm not looking to work more, looking to get away from work. I'm not looking to start a business. I'm not looking to go self-employed. But if you are, or if you're thinking about starting your own consulting business, this is one that you want to pay attention to, and this is one that you want to go over with your tax preparer. But just like the ultra wealthy, these big business owners get these pass-through income tax deduction, same thing is available to anybody who wants to start a company, start a business. All right, move on from that one. Number 6 here, tax breaks from home ownership. Let's talk about this one. I've got a few comments on it. Homeowners get some extra tax breaks, specifically the ability to deduct mortgage interest and property taxes if they itemize. Now, there are certain instances of wealthy people stretching this a bit, such as deducting the interest on a yacht loan because it technically meets the definition of a second home. But the mortgage interest tax break saves millions of everyday Americans money every year. So, just like this article says, this one's available to all of us as well. The keyword in this one, though, keyword to pull out, because I don't want you to just run to your tax preparer and go, why am I not getting the tax breaks on my home? The keyword on this one is if you itemize. Back to itemizing your taxes, back to those standard deductions. If you surpass with all of your different deductions, taxes, mortgage interest, charitable donations, any other deductions that you're able to write off, if all of those surpass your standard deduction, absolutely, you should be taking advantage of this one as well. But many people are unable to have enough deductions past that standard deductions. Now, if you have multiple homes, you've got multiple mortgages, you've got multiple other deductions, this might apply to you. Make sure that you're talking to your tax person to make sure you're taking advantage of it. Okay, number 7. This one's also available to each and every one of us. I have a feeling this one could totally get overlooked, and this one's all going to be based on whether or not you're keeping good records. Number 7, medical expense deductions. Taxpayers who itemize can deduct medical expenses that exceed 7.5% of their adjusted gross income. There are confirmed reports of people successfully using this to deduct expensive swimming pools as therapeutic devices, but the deduction can be used by anyone who has high medical costs. I have no idea whether or not you can deduct your swimming pool as a therapeutic device, but what I do know is that if you do have high medical costs, you might be able to deduct your medical expenses. You might be able to get a tax deduction here. This is available to every American filing taxes, but the key here in this one is actually tracking your medical expenses. And I know a lot of times people are just going to the doctor, getting the bills, paying the bills, doing whatever they have to do, but they're not tracking their medical expenses. So at the end of the year, they're not turning all of this into their tax preparer. If you feel like you have high medical expenses, I would pick up the phone, call your tax preparer, say, whereabouts would I need to be in the medical expense range where it would add up to enough to make a deduction? Let them tell you that number, and then once you have that number, you'll have a good idea of whether or not you may surpass that each and every year. And if you do surpass it, guess what? Start tracking all of those expenses so you can turn them in to your tax preparer so you can get that deduction. But I'm guessing there's people out there that would qualify for this. They're just not tracking it. So that was number 7, and to top it off here, number 8, the 8 ways the richest Americans avoid paying taxes. Hopefully you've seen, as we've gone through this list isn't just for the multi-millionaires. It's not for the multi-billionaires. The list is actually, most of this list is for everyone. It's just understanding the rules. It's understanding the strategies and how you can use the rules and the strategies to your benefit. Some might apply to you. Some might not apply based on your situation. But if you don't know, or if you're working with somebody that doesn't know, well, then how would you be able to take advantage of them? So that's a really important thing here. Last one, number 8, real estate investing tax breaks. Boy, do I want to just really add some, I'll say, stars at the bottom of this one so people aren't just taking this one straight to the bank here. Real estate investments benefit from a ton of tax breaks, including a big one called depreciation. In a nutshell, if you buy a rental property, you can deduct a portion of the price you paid for the property every year on your taxes. In many cases, this makes profitable rental properties show a loss from a tax purpose. Okay, a few caveats on this one because it's just making it sound really good. Go out, buy real estate, and gosh, you can have profit. You can have profit and show a loss from a tax standpoint. You get to depreciate it. And I'm not going to take away from this. Yes, there are tax benefits in regards to owning real estate. No doubt, there are. However, it makes it sound really good, but I also just want to make sure you understand all the different parts of this. First off, if you're earning income from your real estate, don't forget, you're going to have to pay tax on that income. That's part of it. Yes, like it's saying, you get to depreciate the property. That creates a tax deduction. What it fails to mention is what if you want to go and sell that piece of property? Well, they have this thing called depreciation recapture. So when you sell, they're going to reconfigure what your basis is. Just to kind of keep this really simple, let's just say you bought a piece of property for $250,000. Over time, you depreciated $25,000 of it. Well, now it's worth $300,000. That would be a $50,000 gain in your mind. However, because you depreciated $25,000 of it over time, your new basis is $225,000. So instead of a $50,000 gain, you actually now have a $75,000 gain on that property. Folks, there is no free lunch. There are tax deductions. There are helpful ways to reduce your taxes as you go, but there is no free lunch. Now, one of the things that you can do is you can 1031 exchange that into another piece of property. But if you need the money, right, well, then you're probably not exchanging it into another piece of property. So the other thing here help avoid taxes, but this is more family tax bracket management, is that if you hold on to that piece of property then and your children inherit it, well, when they inherit it, they're going to inherit property like that, an asset like that. They call it a step up in cost basis. So you might have depreciated the whole thing. They will then get the step up in cost basis. So in my example where it's now worth $300,000, guess what? You pass away, they inherit it. They inherit it at the $300,000 versus the $225,000. Folks, understanding these rules, having somebody in your corner that's going to help talk through the strategies with you is what's going to help you utilize the tax strategies that are out there that we feel the richest Americans are utilizing, like the multimillionaires and multi-billionaires. They're all available to all of us. It's just understanding them, understanding how to use them, and then taking advantage of the ones that do apply to you to your benefit. So Where to start? Maybe just start with our free guide to unlocking hidden tax savings opportunities. Again, that's at lifemoneyshow.com/taxes. It's going to give you actionable advice, a checklist to utilize, help keep more of it in your pocket versus giving it to the IRS. You can get that at lifemoneyshow.com/taxes. Also, if you enjoyed today's show, enjoyed today's episode, you want to hear additional information on how to help reduce your long-term taxes, how to help you build wealth, how to help make sure that you're ready to retire and maximize that retirement income. Subscribe on your favorite podcast player as we're coming out with new episodes each and every week to help you in each and every one of those subjects. I really enjoyed today's conversation to helping you enjoy life today and be financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.